Welcome to the Deep Dive. Today we're diving into something that sounds simple but can be profoundly life-changing: building wealth through investing habits. Our guide today is the book Investing Habits: A Beginner's Guide to Growing Stock Market Wealth by Steve and Holly Burns. Our mission is to extract the most important nuggets of insight, helping you understand how consistent actions can transform your financial future no matter where you are in your journey.
Yeah, and what's fascinating here, I think, is how the book shifts focus from, complex market details to the behavioral aspects of investing. It really emphasizes that success often comes down to disciplined habits, not just deep knowledge. Like Warren Buffett wisely put it, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant.
That's a great quote. Really puts it in perspective. Okay, let's unpack this. The book gives us a quick lesson on how the stock market works, kind of dispelling the myth that it's just buy stocks and win. So companies go public, that's the IPO, right? They sell shares. Then those shares trade on the open market, price set by bid and ask. And the company's value, the market cap, that's just the stock price times the number of shares. Plus, companies might pay dividends or do stock buybacks. But yeah, the book makes it clear the market isn't some holy grail of riches. It's more like a game of survivorship.
Exactly. And it experiences cycles. Long-term uptrends, they call those secular bull markets. And then the opposite, long-term downtrends, secular bear markets. Plus, you get shorter-term stuff like bubblesthink.com or corrections, a 10% drop. And of course, crashes. Like the big one, maybe 50% drops. Late 2008 comes to mind.
Right. So given all that volatility, where do we even begin? The book makes it incredibly clear it's all about action. Let's talk investing habit, #1. Investing habit, #1. Take action now. It seems the main reason most people don't build wealth in the stock market, they never start. They plan for tomorrow, which, let's be honest, often turns into never.
It reminds me of that Chinese proverb, the best time to plant a tree was 20 years ago. The second best time is now. The book actually draws a comparison to losing weight.
Oh yeah, how so?
Well, investing is a lot like losing weight. It's not exactly rocket science. Success depends more on behavior and consistent action than pure knowledge. The magic is really in just taking that first step.
And what's the power of that first step? Does it just get the ball rolling?
It opens up new possibilities. I mean, the authors share their own story getting to multiple six figures of capital in their 40s instead of having zero. And it was all based on starting and then consistently implementing these principles, taking action, moving from just learning to actually doing. That creates totally new possibilities.
Okay, makes sense. Start now. But once you take that first step, you can't just wander aimlessly. You need a roadmap, right?
Yeah.
So, investing habit, #2. Create and follow a plan.
Exactly. This habit is all about consistent, deliberate action, not just random investing. It means setting specific investing goals. Like, what are you investing for? Retirement, something else, maybe speculation. Then you figure out the account type. Brokerage accounts, IRAs, maybe a 401k or 403b through work.
And the key habit part.
Making it a habit to deposit money into those investment accounts every single month. The book says treat it like any other bill, you just pay your investment account. But instead of paying for something that loses value, like a car payment, you're essentially paying yourself first, building an asset.
Paying yourself first. I like that framing. And how does that connect to the bigger picture?
Well, if we connect this to the bigger picture, having that clear plan ensures your actions are actually aligned with your long-term vision, whatever that is. And your investment account, if you, nurture it consistently, it'll grow. Eventually, it becomes a source of income itself through capital gains, dividends, interest, a second income stream.
Okay, this leads nicely into the next one, which I found really interesting.
Yeah.
Investing habit, #3. Be an employee and an investor. What if your workplace could actually be a key part of your investment strategy?
Yeah, this is powerful. The book quotes Robert Kiyosaki here. He said, people think that working hard for money and then buying things that make them look rich will make them rich. In most cases, it doesn't. It only makes them more tired.
The keeping up with the Joneses trap.
Right. And if you notice, the Joneses are exhausted. So employees often stay consumers, spending on depreciating stuff, cars, electronics, whatever. Investors, though, they accumulate assets, things that appreciate or generate income.
And the workplace connection.
You can profit by being an investor in the very company you work for if it consistently grows sales and earnings.
Plus, many companies offer programs letting employees buy company stock often commission-free, or through their 401k.
Yeah.
So you're kind of getting paid twice your salary and then potential growth as an owner.
Exactly. But it raises an important question. How do you pick a winner in your own workplace? You can't just buy it because you work there.
Right. What should you look for?
The book lays out some clear criteria. Fundamentals first. Look for growing earnings. Maybe 5% or more over last year. 10% plus is excellent. Same for sales, growing sales, 5% minimum, 10% plus is great. Does the company have new products, new tech, new processes, giving it an edge? Is it an industry leader? Good name recognition, solid market share.
Okay, so solid fundamentals. What about the stock itself?
Then you look at the technicals. Is the stock actually in an uptrend, making higher highs and higher lows in price over the past few months? Ideally, it should be close to its 52-week high, maybe within 10-15% of its all-time high.
Got it. Fundamentals and technicals aligning.
But there's a caution here. Even a fundamentally great company stock can fall if the overall market is weak, what they call under distribution. So the 200-day simple moving average is presented as a key signal, a kind of filter. The advice is pretty clear. Sell if the price drops below it, and definitely don't invest in stocks under that line.
Wow, okay, so price action really matters,
Yeah.
even for your own company stock.
Yeah, what's fascinating is how price action, not just the company story, dictates investor behavior. They use Apple stock as an example, 2008, 2012, 2015. Bottom line, you really only want to invest if both the financials and the stock price are in clear uptrends.
Okay, let's move to maximizing growth. This next habit feels foundational, leveraging the tax system. Investing habit #4. Pay yourself before you pay taxes. Like Benjamin Franklin said, in this world, nothing can be said to be certain except death and taxes. So how do we work with the tax part?
Well, the book highlights the threefold power of tax-deferred accounts. Think IRAs, 401ks, 403bs, maybe 457bs. First, they lower your current tax bill by reducing your taxable income now. So, for example, if you make $68,000 and put $18,000 into your 401k, you're only taxed on $50,000.
Okay, immediate tax break. What's the second part?
Your capital grows tax-free, no capital gains tax on the returns year after year while it's in the account. And third, you withdraw in retirement, likely when you're in a lower tax bracket, so you pay less tax overall because your income needs might be lower then.
Makes sense. But what about Roth accounts? You pay tax now with those. Why emphasize tax deferred?
That's a fair question. The book frames it this way. Why would you want to be taxed in your peak earning years on a Roth, losing out on compounding that tax money over potentially decades, especially if you expect to be in a lower tax bracket during retirement? Using tax deferred changes the usual flow from income taxes paycheck to income investing taxes paycheck. You get to keep and compound money that would otherwise have just gone straight to taxes.
Give me an example.
Sure. Say you earn $1,000, tax at 25%. That's $750 take home. But if you put that $1,000 into a tax-deferred account first, the whole $1,000 stays invested and can compound completely tax-free until withdrawal. It's a huge difference over time.
Got it. Okay, next up, the famous one, the eighth wonder of the world.
Yeah.
Investing habit #5. The power of compounding returns.
Ah, yes, compounding. The book shares a neat little anecdote. One of the authors at 16 was just fascinated by how money could grow all by itself. They explain how, say, $10,000 earning 12% a year doubles in about 6 years. Then it doubles again. Eventually, it's making back your original capital every few years.
And they mentioned the rule of 72, right? It's a shortcut.
Exactly. It's a quick way to estimate doubling time. Just divide 72 by your annual rate of return. So 72 divided by 12% return. Yep, equals 6 years to double. Simple but powerful.
But there's a flip side to compounding, isn't there? A crucial counterpoint.
Absolutely. If we connect this to the bigger picture, the key to successful compounding isn't just getting returns, it's not losing money. You have to avoid excessive risk-taking, or, importantly, not having an exit strategy. The math is stark. Lose 10%. You need an 11% gain just to get back to even. Lose 50%. You need a 100% gain to break even. It's much, much harder to regain lost capital than to protect it in the first place.
Wow. So what's the advice then?
Stick to solid companies or bonds for the core of your investing. Avoid super high-risk stuff like penny stocks or derivatives for investing purposes. Maybe trading, but not investing. They share a cautionary story about a friend who cashed out $15,000 from a retirement account early.
Oh no, what happened?
The long-term cost was huge. We're talking 6 figures lost due to the early withdrawal penalties and all the missed compounding over the years. A painful lesson.
So the message is clear. Don't touch that long-term investment money. How do you protect it from life's emergencies?
This means planning. You absolutely need an emergency fund set up separately, and having the right insurance, health, disability, etc. That protects your long-term capital from those life happens moments. Basically, leave the financial seeds you've planted alone so they can actually grow, ideally until retirement or whenever you reach financial independence.
Okay, this next one sounds almost too good to be true. Investing habit, #6. The 100% return that most people miss. An instant, risk-free 100% return. Really, where?
It sounds like Vegas, right? But it's often available right in your own workplace. We're talking about employer 401k match programs. These are part of most companies' benefit packages now, often replacing older pension or profit-sharing plans.
Explain how it works, the 100% part.
Okay, simple example. You make $50,000 a year. You decide to contribute 5% to your 401k, which is $2,500. If your company offers a dollar-for-dollar match up to 5%, they put in another $2,500. So your $2,500 contribution instantly becomes $5,000 in your account. Boom. An instant 100% return on your money before it even starts investing.
That's just free money. Why would anyone miss this?
Right. This raises an important question. Why miss out? Often it comes down to opportunity cost. Think about it. If taking on a, say, $400 new car payment stops you from contributing the $400 a month you need to get the full company match, well, that car isn't just costing you $400 a month, it's really costing you $800 a month because you're losing the $400 match. That's the missed opportunity.
That's a powerful way to look at it.
Yeah.
What if the match requires buying companies' stock? Is it still as good?
The book argues yes. Even if you have to buy company stock with the match, it's like buying it at half price. This creates an incredible safety margin. Say the stock is $40. Your actual cost basis, thanks to the match, is only $20. If that stock doubles to $80, you haven't just doubled your money, you've made a 300% return from your $20 cost basis. The advice is simple. Set up automatic payroll deductions to get the full matched amount. Always. It's non-negotiable.
Okay, switching gears a bit. Now that we know why and how to consistently invest, let's look at what to invest in. And this next habit might surprise some people. Investing habit, #7, how the S&P 500 index beats mutual funds. The book cites the New York Times reporting that out of nearly 3,000 U.S. stock mutual funds in 2009, basically none consistently beat the market. 0.
Yeah, it's pretty shocking when you see the data laid out. The core issue with actively managed mutual funds is that they charge fees, management fees, administrative fees, sometimes 0.2%, sometimes up to 2% or even more. And you're paying those fees often for a performance that underperforms the benchmark index anyway. Those fees really eat into your compounding over the long haul.
So if actively managed funds often fall short, what's the alternative the book recommends? Why do index funds win?
Index funds, like the SPY ETF, which tracks the S&P 500. What's fascinating here is their simplicity. First, they have very small management fees. SPY's is tiny, like 0.09%. Second, they follow a clear, rule-based system. It's not based on some manager's opinion or emotions. And third, well, it is the market benchmark. So by definition, it can't underperform its benchmark.
And there's that survivor biases thing too, right?
Exactly. Indexes have survivor bias built in. The biggest, most successful companies, the ones whose stock prices are generally going up, get the most weight. Companies that falter eventually get dropped from the index. So indexes are naturally adaptive. They're designed to reflect the actual economy as it changes. Think about the Dow Jones components back in 1896, mostly agrarian stuff, commodities. Compare that to 2016 tech, credit cards, entertainment. Indexes evolve.
That makes a lot of sense. So
Yes.
how can listeners easily buy into an index?
Super easy these days, exchange-traded funds or ETFs. You buy and sell them just like stocks or any broker. Popular ones are SPY for the S&P 500, DIA for the Dow, QQQ for the NASDAQ 100, IWM for the Russell 2000 small caps. Also, many 401ks offer index mutual funds, which serve the same purpose. Just make sure you avoid any mutual funds with load charges, those upfront or back-end sales fees, and watch out for redemption fees too.
Okay, now for maybe the most controversial habit in the book. It really goes against the grain of typical advice. Investing habit, #8. Don't buy and hold through bear markets and crashes. We're always told buy and hold forever, stay the course. Why does this book say don't?
Yeah, this one definitely challenges conventional wisdom. Buy and hold looks great on a chart spanning, 50 or 100 years. The market averaged maybe 10% a year in the 20th century, even 18% in the 1990s. But the book offers a powerful counter-perspective looking at specific long periods where it was actually pretty ineffective. Like the entire decade from 2000 to 2009, the Dow Jones actually closed lower after those 10 years. Buy and hold got you nowhere, or worse.
Wow. Any other examples?
Oh, yeah. There were times the Dow took 28 years from 1905 to 1933 just to permanently get back above its previous high, or 17 years from 1965 to 1982. Holding through those massive drawdowns and long periods of stagnation, it's tough. As the book puts it, you don't have to pay a mutual fund manager or financial advisor to not get a return. You can do that on a savings account with virtually no risk.
And the psychological impact of those drawdowns must be huge.
Immense. That's when bad decisions happen. People panic, sell near the bottom out of fear, not based on a system. So, if we connect this to the bigger picture, the goal isn't just making money when things go up. It's crucially about not losing huge amounts when things go down, protecting your capital.
So how do you do that without trying to perfectly time the market, which we know is impossible?
This is where that 200-day simple moving average comes back in, but as a risk management tool, a price filter. When a major index like the S&P 500, using SPY for example, closes below its 200-day moving average, the book suggests treating that as a signal that a correction or bear market might be underway. It helps you get out, maybe not at the top, but early enough to avoid the really big, devastating losses, and then helps you know when it's potentially safer to get back in.
Does the data back this up?
The book presents compelling data. For SPY, from January 2000 to October 2015, using the 200-day SMA strategy yielded total returns of 96.1%. But crucially, the maximum drawdown was cut roughly in half, only 27.3%. Compare that to buy and hold over the same period. Similar return, 91%, but with a gut-wrenching 55.2% drawdown. So the emphasis is on having both an exit strategy and a re-entry strategy. Finding a process that works for you can save a lot of financial pain.
Okay, let's shift from just growth to income, investing habit, #9, investors' cash flow. Beyond the stock price going up, how else do investments pay you?
Right, through income. Dividends are a big part of this. The book notes that from 1930 to 2012, dividends actually accounted for about 42% of the stock market's total returns. That's roughly 3.9% per year just from dividends, on average.
So how does that work? Where did dividends come from?
Well, when companies make profits, they have choices. They can reinvest back into the company, maybe buy other companies, repurchase their own shares to boost the price, or they can pay out a portion of the profits directly to shareholders as dividends, usually paid quarterly. You calculate the dividend yield, and yeah, the stock price typically drops by the dividend amount right after it's paid, but it's still cash in your pocket as an owner.
When investing for income, what's the priority? Is it just finding the highest yield?
This raises an important question. How do you ensure safety while seeking income? The book is very clear. The #1 priority for income investing should be capital safety, not just chasing the highest possible yield. For bonds, it's simple. Higher risk generally means higher interest, and lower risk means lower interest. You get paid for the risk you take. So the advice is to stick with strong companies that have a history of consistent, growing dividend payouts. Don't just jump at the highest yield number.
And for bonds?
For bonds, diversification is key. Use bond ETFs or bond mutual funds. Avoid putting all your eggs in one basket, like one company's bonds or one specific sector. And interestingly, the book suggests using that same 200-day SMA rule even for income investments. Basically, don't buy an income ETF or fund unless its price is trading over the 200-day moving average. And consider exiting if it drops below or if a company cuts or stops its dividend. Protects your principal.
All right, we're on to the final habit, a strategy to reduce stress and spread risk. Investing habit, #10, dollar cost averaging.
Yes, dollar cost averaging, or DCA. It's defined as staggering your buys into a long-term investment. The main point is that it makes your short-term timing less important. You're not trying to nail the exact bottom.
But who is this strategy actually for?
Good distinction. What's fascinating here is that the book positions DCA firmly for investors buying long-term holdings for fundamental reasons, people building a position over time. It explicitly states that traders who operate on shorter time frames based on technical signals should never average down into a losing position after their initial trade idea was proven wrong. That's just adding to a mistake.
Okay, so for long-term investors, when is the best time to use dollar cost averaging?
The book suggests it's best used with things like index funds inside retirement accounts, where you have a long time horizon, especially effective during a general market uptrend when the index is trading above its 200-day SMA. Or potentially after a big market correction, say 20% down, once the price seems to have found some support and stabilized for maybe a week or so, you can start averaging in then.
And when should you not use it?
Definitely do not dollar cost average blindly into a prolonged downtrend. That's like trying to catch a falling knife. And don't use it if you're fundamentally wrong about the investment itself, like keep buying Blockbuster shares while Netflix is clearly eating their lunch. If the story changes, DCA doesn't help.
So what's the core benefit? How does it help psychologically?
The main benefit is that you automatically buy fewer shares when the price is expensive and more shares when the price is lower. This averages out your cost basis over time. It increases your probability of eventually being profitable. And yeah, it makes investing more psychologically comfortable because it takes some of the pressure off finding that perfect entry point, less stress.
Do they give an example of how to apply it?
They do. For instance, after a correction, maybe you decide to enter 20% of your planned investment capital when the market closes back above the 200-day SMA. Then maybe add another 20% each day it stays above that line. So after 5 straight days above the 200-day, you'd be fully invested again. It's a systematic way to ease back in.
Wow, what a deep dive into these really practical habits. It feels like they can truly transform your financial life. We've covered so much taking action, the importance of a plan, using employer benefits like the 401k match, the magic of compounding, the efficiency of index funds, why having an exit strategy is crucial, generating income, and using dollar cost averaging smartly. And throughout, the idea of a diversified portfolio comes up again and again: growth stocks, maybe your company's stock, index ETFs, income funds, bonds.
Exactly. And if we connect this all back to the bigger picture, these habits aren't just about the mechanics of making money. They're really about building confidence in your future, creating financial independence. It's about that fundamental shift, from just selling your time for money to having your money actually start working for you, creating returns on your returns. That's the goal.
So let's leave our listeners with this. What does this all mean for you? Consider which of these 10 investing habits really resonates the most right now. Maybe which one feels like the biggest gap in your own approach. And perhaps more importantly, which one single habit could you take action on today or this week to start or maybe accelerate your own wealth building journey? What's that one thing you've been putting off that could genuinely set the stage for your financial future? Something to think about.